The market is currently closed for Plug Power Inc., with the last reported closing price on Monday, December 8, 2025, at $2.16 per share, marking a decline of minus $0.04 or minus 1.82% from its previous close. This price action, dipping back toward the lower end of its recent trading range, immediately sets up a fascinating point of tension for the week. The market narrative hinges on the idea that the company has successfully shored up its balance sheet and secured key contracts, yet the stock simply cannot sustain a rally above the $2.30 to $2.50 resistance zone. The immediate, unexpected insight here is that while the market is focused on the recent financing that netted $399 million in cash and eliminated a first lien, which is undoubtedly positive for liquidity, the true weight dragging the stock down is not the lack of demand for their product, but the sheer relentless dilution risk inherent in their forward strategy, especially with the proposal to double the authorized common stock to 3 billion shares coming up for a vote in January 2026. This potential move creates a perpetual overhang that is more powerful than any NASA contract announcement, and it's why the stock price keeps getting pulled back to earth despite positive operational news. The general belief among many investors, especially those drawn to the green energy theme, is that Plug Power, or PLUG, is the indispensable infrastructure play for the hydrogen economy, a pure-play company whose valuation simply must reflect the future massive scale of clean energy adoption. They see the Georgia and Louisiana plant build-outs, the contracts with major retailers like Amazon and Walmart for material handling fuel cells, and the expansion into stationary power and electrolyzers as undeniable proof of long-term vision and execution. This expectation is rooted in the government's support for clean hydrogen, particularly in the U.S. with the Inflation Reduction Act's tax credits, which the market believes will eventually guarantee profitability for large-scale green hydrogen producers. However, the reality, as reflected in the stock's daily swings and long-term chart erosion, is that the capital intensity and execution risk of becoming a large-scale liquid hydrogen supplier are dramatically higher than the market is willing to currently credit. The company's persistent gross margin and net losses, even as revenue grows, are a cold shower on that optimistic narrative. Daily volume remains high, frequently topping the 90 million share mark, indicating massive speculative interest and professional hedging activity, not stable long-term accumulation. The intraday low of $2.09 on Monday, immediately before closing slightly higher, suggests that every small rally is being used as an opportunity for either short-term traders to take profits or, more structurally, for institutional holders to trim positions and manage risk. This intense daily back and forth confirms that the market is deeply divided. One camp sees a future utility, the other sees a never-ending cash burn machine requiring constant fundraising. Examining the recent trading pattern shows a stock that jumped nearly 11% in the first week of December on the back of news of starting its first liquid hydrogen contract with NASA and signing a letter of intent with Hy2Gen for a 5-megawatt PEM electrolyzer project in France. These are legitimate, foundational business wins, yet the price immediately retreated, giving back much of those gains because, to put it plainly, a $2.8 million contract with NASA, while prestigious, does not materially offset hundreds of millions in quarterly losses. The capital raise via convertible senior notes in November, which was essential for liquidity, also comes with the eventual cost of dilution, something that sophisticated institutional investors who filed numerous 13F forms showing a mix of increasing and decreasing positions recently are keenly aware of. For example, While some firms showed modest increases, the activity from major players like Jane Street Group, with both large long call positions and significant shares, alongside a substantial put position, reveals a sophisticated multi-directional trading approach that points to high volatility, not conviction in a steady upward climb. The core business model of Plug Power focuses on a vertically integrated hydrogen ecosystem. This means they are not just making the fuel cells used in forklifts and commercial vehicles, their initial main product, but they are now building the electrolyzers to produce green hydrogen, the liquefaction and distribution infrastructure, and the fuel stations. It's an enormous, sprawling ambition to own the entire supply chain. Their material handling business, serving names like Walmart and Amazon, remains a steady base, but the real story, and the source of the high capital needs, is the green hydrogen production network. This transition from a hardware provider to a utility-scale infrastructure company is the central driver of their historical performance, characterized by rapid growth in sales, but even faster growth in cost of revenue, resulting in those deep gross margin deficits. Older reports from 2024 and earlier consistently show the struggle to achieve a positive unit economic profile at scale. The promise has always been that scale would fix the cost structure, but the build-out costs keep escalating, often forcing them back to the equity or debt markets. Now, let's talk about the elephant in the room that is largely driving the skepticism and the tight trading range: short-selling awareness and activity. Plug Power is a heavily shorted name, and the data confirms it. The latest reportable short interest stands at over 305 million shares, representing a staggering 23.29% of the public float. The days to cover (DTC) ratio, which helps gauge the risk of a short squeeze, hovers around 3.06 days, which is above the threshold that gets retail traders discussing a potential squeeze. This is a clear indicator that a significant portion of the market actively believes the stock is overvalued, or that the company will continue to struggle with profitability and capital management. The short thesis is straightforward. The company's valuation is based on subsidized future profits that may never materialize at the projected scale, and the persistent need for financing through share offerings will keep the stock price suppressed regardless of operational wins. The borrow fee rates have been low, generally under 1% annually, which suggests that while the sheer volume of short shares is high, the cost to maintain those short positions is not prohibitively expensive, meaning short sellers are not currently under acute time pressure to cover. However, the high off-exchange short volume ratio, which has been reported around 50% recently, is a recurring point of contention on retail forums like Reddit and X. Many retail investors interpret high off-exchange volume as potential manipulation or dark pool activity, suppressing the price. The reality is more nuanced. A high off-exchange ratio can simply reflect large block trades, institutional hedging, or market maker obligations, but it absolutely signals that the institutional trade flow for Plug UG is complex and heavily skewed toward professional speculation. Actionable insight for the retail investor here is to monitor the short interest percent float on the next reporting date alongside the days to cover, and to pay close attention to the option open interest. For Plug UG, the put open interest has historically been high, suggesting traders are buying protection or betting on further downside, which aligns with the short thesis. Investors should use a resource like FINRA for the daily short volume or NASDAQ for the bi-monthly official short interest report. Any spike in borrow cost or a substantial drop in the number of shares available to borrow, which recently stood around 1.3 million, would be a more immediate technical sign of pressure on the short side than the ongoing debate about dark pool trades. Let's address the retail sentiment directly. The discussions on forums often reflect frustration and a coordinated bullish push against what is perceived as institutional shorting. The recent news that a significant portion of Plug shares loaned out to short sellers comes from retail accounts, which can lead to loss of voting rights, has fueled calls for better share transparency and coordination. My take is that retail investors need to understand the mechanics. The stock lending is often automatic through margin accounts. To react responsibly, individual investors must distinguish between fundamental risk, the company's financial health, and technical risk, short interest and trading dynamics. A short attack is typically based on an underlying weakness, in this case, the negative cash flow and dilution. While a short squeeze is possible given the float percentage, chasing it blindly is extremely risky, especially for a stock in this price territory, which is very susceptible to sudden, large offerings to raise capital. For the future outlook, the expectation is that the 45V hydrogen production tax credit from the IRA will finally kick in and dramatically improve the unit economics for their green hydrogen projects. The reality is the Treasury Department is still debating the rules,